So yes, we are seeing consumers keep their cars a little longer, and especially now with so many loans being 72 and 84 months, that is leading to consumers keeping those cars just a little bit longer.
Good morning. I am Dennis McGinn, founder and CEO of vehicle reconditioning and communications company, Rapid Recon. At your place, we visit guests at their place of business to engage in conversations about the auto industry. Today, we're talking with Melinda Zabritski, the Senior Director of Financial Solutions for Experian Automotive. Throughout her career with Experian, Melinda has overseen the product strategy for Experian Automotive's lending channel and creation of the automotive credit vertical. Today, she serves as Experian's primary analyst and spokesperson regarding key automotive finance trends. Hi, Melinda. Welcome. And did I miss anything in that introduction?
Thanks, Dennis. These days, I primarily focus on consulting and industry analysis, which I've been doing for a very long time. So thank you for not mentioning how many years.
I don't do that coming my way either. So thank you. Mutually assured non-destruction. So what gets you excited about data and numbers? You must just wade in those in what you're doing. So I'd love to hear something about how you pick the right ones.
Well, there's so much to really dig into and get excited about. At Experian, we have so many great data resources, and I'm lucky to focus on our vehicle title and credit data. And it's really fascinating to be able to dig into what types of vehicles consumers are purchasing and how the financing changes. And each quarter, there's always something a little different and a little unique. So it's exciting to dig into the numbers and see really what's changing and there's so many things to focus on. There's always unique things that come out every single quarter.
Well, we love data too at Rapid Recon. We're focused more on key performance indicators. Our customers use our data to help manage the operations like used car reconditioning and the speed to sale. So how do your users use your state of the automotive finance market report?
Sure. So we have a really broad audience for the state of the auto finance market. Everyone from lenders, investment analysts, researchers, and of course, dealers. From the dealer standpoint, it's of course important for everyone to pay attention to the local trends. Each market is unique. But it's also important to understand the broader macro trends that impact the industry. For instance, while many dealers, again, will likely be working with numerous local credit unions, they're also working with the large national lenders. And, these large lenders need to balance their originations across the country. So, being aware of the macro trends can also help understand what's happening within, the individual unique markets.
Yeah, and I know that credit union originations continued strong. We had Darren Lawrence of Cuddle here not long ago, and he helped us understand how that market serves dealers. From Experian's most recent report, what does the data tell us who use your data services and what opportunities they're using to project their part of the used car business?
So yes, certainly credit unions gain significant market share. They're now the leading lending segment, especially for used vehicles. I would say from the used car side, seeing that the credit union market share and observing, the near record highs in the loan amounts and payments, that it's really important for especially used dealers to have a broad selection of full spectrum lenders for financing. Many credit unions have put on record volume of originations lately. And that does have the potential for them to slow down. So in order to handle that volume. So used dealers, especially right now, ensure that you have strong relations with, other lenders to work with in case we do see some slowdown from some of those local credit unions.
I know that the dealers have these special relationships and with the credit unions. What would you say the percentage of business these days and the market that flows through credit unions for financing?
Right now, depending if you're looking at new or used vehicles, but right now we're seeing them as the largest lending segment. And on the used vehicle side, over 30%, having gone from, the low teens to basically doubling their market share in just a few short years. So it's been, especially in the last year, it's been some tremendous growth.
And I mean, with the recent increase in interest rates that are going on, of course, to try and control the inflation that's all around us right now. How does that ripple through into the performance of these instruments?
Well, and that's the primary reason why we're seeing that very dramatic credit union share growth. When we started to get the rate increases earlier this year, the banks responded quickly. They started raising their rates and have steadily been raising their rates, while credit unions were a little slower to do their rate increases. In the second quarter was where we really saw the banks increase. Credit unions still were relatively flat. Third quarter, they did start to raise their rates, but we're still seeing credit union rates a couple hundred basis points lower than banks across the board. So many dealers are finding that there's just no way to beat the credit union rate with other lenders. And of course, on the new car side, the captives aren't really doing the incentives. So lots of share growth coming in right now on the credit unions. Nothing like working it from home with pets in the
I
house.
love it. I I love it. Now Jim's on. He has one that every once in a while comes in the screen and just pokes him on the side, and it's feeding time.
Yep.
So I mean, we have our animals. I mean, from what I know about the back end processes in the dealers, of course, I think if they use their own captives, they're making more money. But what is it about the credit unions that draws? Is it the rate? I guess the rates are
Mhm.
always a little lower if you qualify.
Yeah.
So that's a big drawing card.
Absolutely. And the credit unions, we do tend to see the credit unions do tend to finance a little bit more of a prime consumer. The terms tend to be a little bit longer, which also helping to keep that payment lower. So from that
Yeah.
standpoint of trying to find the lowest monthly payment, which we know most consumers are monthly payment shoppers, between the lower rates and the slightly longer terms, we're seeing the credit unions tend to have some of the best payment options out there. So that's certainly the biggest reason why we're seeing that share growth.
This is just kind of curiosity, but are people already belong to those credit unions? Well, I guess if they're going to be financing, no, not necessarily.
Not
They,
always to start with. Depending on the credit union's charter, you could have, in many instances, in the process of originating that loan, you've got a $5, $10 deposit that goes into a savings account or a checking account, and that creates your membership. So it'll depend on the charter of that credit union of how they can bring in members. But I think I have 3 or 4 checking accounts with credit unions around the country with $5 or $10 sitting in them.
yeah, gets you started, and then you get the communication with them. So as we're kind of running toward the end of the year, and we've got this big NADA coming up here in just the end of January, and everybody's trying to obviously in my part of the world, it's about reconditioning and getting cars ready to sell, and it's the time to line that I talk a lot about is really become the bottom line. I mean, it used to be inventory turns and things, but now it's all about how getting cars from the sources because you can't get them where you used to, and now they're getting them from locally from buying centers and then getting them ready. But as soon as they make that decision, whether it's a trade or a purchase or whatever, it's the car needs to be up online now. So that window is really short. And of course, if you've got a decision process going like that, and the financing is right in there, it's all got to flow well. But what do you see looking forward in your inside thinking about this going into next year? And what is the magic things that you look at? What do they tell you is going to happen in the first couple quarters next year?
Yeah, well, everyone, of course, we wish we had a crystal ball to figure out when inventory and supply demand levels out. Unfortunately, we don't have that. But we are starting to see some slowdown of some of those year over year and quarter over quarter increases in used car loan amounts. And the growth in values for used vehicles seems to be tapering off. Of course, it's still elevated, but it does the increase seems to be slowing down. We still have some decent volume of off-lease vehicles that originated a few years ago, but of course that's going to begin to taper off as we've decreased leasing over the last 2 years. And of course, today with leasing, less than 20%, that's going to have a longer impact on the return of late model used vehicles. I'd expect to continue to see strong demand for the late model used vehicles in the market, and especially for cars and sedans. As consumers, especially those subprime consumers, seek lower payments through either trying to find, again, cars and sedans or some of the later model used vehicles, where, again, there's going to be some fewer SUVs, or, again, having to go back maybe 4 or 5 years for especially those subprime consumers in the used space to find something that's affordable.
Are you seeing the consumers are keeping the cars longer these days? I mean, is the average year stretching out, and then does that go along with their payment, their ideal payment approach?
We have seen a little bit of an increase in that of consumers keeping the vehicles a little longer. There's been a little bit of a slowdown in scrappage rates, where they're starting to increase again a little bit lately, but they're still suppressed from where they've been in prior years. So yes, we are seeing consumers keep their cars a little longer. And especially now with, so many loans being, 72 and 84 months, that is leading to consumers keeping those cars just a little bit longer. I think, again, we're still going to have very strong demand. I think we're still faced with, again, more raising rates, seeing those record high loan amounts. I think everything we can do to, again, from the dealer side, the mix of inventory to enable customers to have options with the attempt to keep some of those payments lower. Because, of course, we all know as the payments increase, likelihood of delinquency also increases. So, again, it's, I think, really keeping that good mix of inventory, if possible, to enable consumers to find the right vehicle.
That's great. Yeah, I've seen delinquencies are a little bit up or trending up, but I guess that's part of what goes on. So, Melinda, could you tell us a little bit more about the report that you actually developed for the industry? That would be really helpful.
Sure. So the Experian State of the Auto Finance Market Report, it's a quarterly webinar or industry trends presentation where we're focused on insights that are derived from vehicle registration as well as credit data. So essentially what we're putting together are insights into what are consumers purchasing from new vehicles and used vehicles? How is the financing being conducted? Who are the lenders or lender types that are gaining share or decreasing share? And a lot of insights around what's happening with monthly payments, loan rates, terms, and a lot of that information split down between new vehicle financing, used vehicle financing, loans and leases, and across the different risk spectrums. So trends on average credit scores and again loan amounts, rates, and terms. So it's a lot of insights that folks can get to really understand the macro view of the industry.
And do you get all your sources from all over the industry in terms of what's going on? How do you actually source the information?
So the data is all Experian source data. We receive DMV title and registration information from all 50 states that we use statistically to analyze the market. And of course, being Experian, we're also looking into our consumer credit database, looking at overall outstanding balances of automotive loans as well as loan delinquency.
Okay. Well, I like I say, I think it's really fascinating, and watching that as it changes, trying to have some foresight in how the economy and people's preferences and availability in the market all comes together, because it all has to work in concert. Do you see any differences across the country from your data? I mean, you get down to where you see trends on a regional basis that are different than another part of the country?
Oh, absolutely. There's differences from, for example, of different parts of the country from a lender type have a greater credit union concentration. You do see, for example, in the Northeast, you see more credit unions. In the South, you do tend to have more geographic base. There's a greater concentration of subprime consumers in the southern part of the country. There's also different preferences, of course, in the types of vehicles people purchase around the country. Again, just mentioning the Northeast, you get a lot more of the SUVs, CUVs, heavy Subaru concentration, different brands,
Yep.
different vehicle types around the country. Of course, you can't help but mention Texas and the F-150. So, of course, yes, definitely differences in geographic preferences. Also, different parts of the country tend to lease more than others. Again, for example,
All
the
right.
South, not a lot of leasing. Northeast, you see a lot more leasing.
Yeah, that's interesting. That usually related to the business expensing of the use of the vehicles.
Yeah,
Or
well, and for example, like Michigan, you get heavy leasing in Michigan because, of course, it's domestic production capital, so you get a lot of the employee leasing vehicles. But yes, lots of differences in financing and just different loan characteristics around the country.
Yeah, that's fascinating too. I never even think about that, but because I'm one stage removed, but it makes a lot of sense. And but leasing in general is is moderating across the country, I guess. Is that right? It's just been going
Yeah.
away from that for a while.
Yeah, so we hit some peaks a couple years ago with leasing as much as, 35, 36% of all the retail new car sales. These days, we're only at about 18%. So it's dropped considerably in the past 2 years, along with, as inventory dropped, leasing dropped as well.
Okay. Okay. Yeah, makes a lot of sense. Okay, well listen, any other trends that you can think of that come through your report that would be interesting for our listeners to know?
We could spend an hour talking about the talking about the different trends in what we're
Da-
seeing.
data
Um,
diving.
Yeah,
Um,
we hit a lot of them. Again, I think there's again some of those record highs in the loan amounts, but especially on the used car side, again, starting to see that tapering off a little bit. But still, for a consumer who might have been out of the market for a couple years, their last used car payment could have been 350, 400, and now it's going to be 550, 600.
yeah,
So some sticker shock for some of those consumers who are coming back into the market these days.
that's interesting. And so it's our job to get those cars ready for them and make sure they're up to snuff and that they are what the dealers represent them to be, completely reconditioned, so they're reliable for sure. Well, listen, hey, thank you for taking the time today. I know you're really busy, and I appreciate you taking some time out for us to kind of give us a little insight into this really fascinating area and really a vital part of the business that we're in too. Is helping the people afford these vehicles. So, thank you for your time today, and appreciate all your insight and your thoughts, Melinda. Thank you.
Thank you, Dennis.